Imagine you have $10,000 sitting in your bank account. You've worked hard for it, you've saved for years, and now you want to invest it, but you don't know where to start. So you open an AI tool and type, "Where should I invest my $10,000?" Within seconds, you get an answer, a list of investments, reasons to consider them, potential returns, risks, maybe even a suggested portfolio. It looks professional, it sounds intelligent, and suddenly, you feel like you have your own financial analyst sitting in your pocket. But here's the problem. What happens if the AI is wrong? Because when you're asking AI to write an email, a mistake might be embarrassing. When you're asking AI to create an image, you can simply regenerate it. But when you're asking AI what to do with your money, a bad decision could cost you thousands. And this is becoming a bigger question every day. AI is changing the way people research companies, analyze markets, and learn about investing. But should you actually trust it with your money? Welcome back to Just Invest. I'm John. And today we're going to break down exactly how AI is changing investing, what AI is actually good at, where it can go wrong, and most importantly, how you can use AI as an investing tool without allowing it to control your financial future. Let's get started. AI has changed the information game for most of investing history. Information was difficult to access. If you wanted to research a company, you might have needed to read financial newspapers, annual reports, analyst reports, and other documents. You had to spend hours trying to understand what everything meant. And if you were a beginner, it could be overwhelming. Today, the situation is completely different. You can ask an AI tool, "Explain this company's business model to me like I'm a beginner." You can ask, "What are the company's biggest competitors? What are the biggest risks facing this industry? Explain this financial statement. What questions should I ask before investing in this company?" And within seconds, you can have a starting point for your research. That is powerful. But there's an important distinction. AI has made information easier to access. It has not made investing risk-free, and those are two completely different things. AI is not a crystal ball. Let's say you ask an AI, "Will this stock go up next year?" The AI might analyze historical performance. It might look at the company's financials. It might discuss industry trends. It might consider economic conditions. But eventually, it has to deal with something nobody can completely predict: the future. Markets aren't mathematical equations where you simply enter the numbers and receive the correct answer. They're influenced by millions of people making decisions. Investors react to news. Companies change strategies. Governments change policies. Interest rates move. New competitors appear. Entire industries can be disrupted. A company can report excellent earnings, and its stock can still fall. A company can report terrible results, and its stock can sometimes rise. Why? Because the market isn't only reacting to what happened, it's reacting to expectations. And expectations can change incredibly quickly. That's why even professional investors can get things wrong. So, if an AI tells you this stock has a high probability of increasing, you should never interpret that as this stock is guaranteed to increase. There is a huge difference. What AI is actually good at. Now, let's talk about where AI can genuinely help investors. And there are several areas where it can be extremely useful. First, understanding complicated information. Financial documents can be difficult to understand. AI can help translate complicated terminology into plain English. Instead of staring at a 100-page document, wondering what you're reading, you can ask questions about specific sections. That can make financial research much more accessible. Second, generating research questions. This is an underrated use of AI. Instead of asking, "Should I buy this company?" ask, "What should I investigate before deciding whether this company is worth investing in?" Now, AI isn't making the decision. It's helping you think. That's much more useful. Third, comparing companies. You can ask AI to help organize information about two businesses: revenue, profit margins, debt, competition, business models, growth opportunities, risks. This doesn't mean the AI's comparison is automatically correct, but it can give you a framework for what to investigate. Fourth, learning. If you're new to investing, AI can act like a tutor. You can ask, "Explain compound interest." Then, Give me an example. Then, explain it again using simple numbers. Then, show me how it affects someone investing $200 a month for 20 years. That ability to ask unlimited questions can be incredibly valuable. The biggest problem with AI investing. Now we get to the dangerous part. AI can give you an answer, even when the answer is uncertain. And because the answer is written clearly, it can feel more reliable than it actually is. Imagine asking, "What's the best stock to buy right now?" You receive a detailed response. It mentions revenue growth, market share, profitability, industry trends, future opportunities. Everything sounds convincing. You think, this thing knows what it's talking about. But here's what you need to remember. A confident explanation isn't the same thing as a guaranteed prediction. AI can sometimes produce incorrect information. It can misunderstand a question. It can rely on incomplete information. It can miss important context. And even when every piece of information is correct, the conclusion can still be wrong. Why? Because investing involves uncertainty. The danger of overconfidence. Technology can create a dangerous illusion. The illusion that because we have better tools, we must have better predictions. But that's not necessarily true. Imagine you have a weather app. It says there's a 70% chance of rain tomorrow. Would you say, it will definitely rain? Of course not. It's a probability. Investing is similar. There are probabilities, there are possibilities, there are scenarios. But there are very few guarantees. And if you start treating AI predictions as guarantees, you can take much more risk than you realize. This is especially dangerous for beginners because beginners often want certainty. They want someone to tell them, buy this, sell this. This will go up. This is the next big opportunity. But successful investing isn't about finding someone who can predict the future perfectly. It's about making reasonable decisions while accepting uncertainty. AI can also feed your confirmation bias. Here's another problem. Sometimes, you don't actually want advice. You want confirmation. Let's say you discover a company you really like. You've already decided you want to invest, so you ask AI, "Why is this company a great investment?" The AI gives you reasons: growth, innovation, market opportunity, strong brand, future potential. You feel even more confident. But what if you asked a different question? What are the strongest arguments against investing in this company? Suddenly, you might discover risks you hadn't considered. This is why the way you ask AI questions matters. Don't use AI only to prove yourself right. Use it to challenge yourself. Ask, what could go wrong? What assumptions am I making? What would make this investment a bad idea? What information would change the conclusion? These questions can be much more valuable. The difference between research and prediction. This is probably the most important distinction in this entire video. AI can be useful for research, but research is not prediction. Let's say you're considering investing in a company. AI can help you understand what the company does, how it makes money, who its competitors are, what risks exist in the industry, how the company has performed historically, what questions you should investigate. That's research. But asking, will this stock double next year? That's a prediction, and prediction is where uncertainty becomes much greater. You can research everything and still be wrong. That's not a failure of research. That's simply the reality of investing. Should beginners use AI to invest? If you're a beginner, I'd say AI can be incredibly useful. But don't use it as your personal stock picking machine. Use it as your financial education assistant. For example, instead of asking, what should I buy? Ask, teach me how to evaluate a company. Then ask, what financial metrics should I understand? Then, explain price to earnings ratio. Then, what are the limitations of using that metric? Now you're learning, you're developing your own ability to evaluate investments. And that's much more valuable in the long run, because if AI disappeared tomorrow, you'd still understand what you're doing. Don't forget about diversification. Another mistake people can make with AI is becoming overly concentrated. AI identifies an exciting company. You become convinced. You invest most of your money into it. Then something unexpected happens. The stock drops. And suddenly, a large portion of your wealth disappears. That's why diversification matters. Diversification doesn't guarantee profits. It doesn't eliminate losses. But spreading investments across appropriate assets can reduce the damage caused by one investment performing badly. The exact right allocation depends on the individual, your goals, your time horizon, your risk tolerance, your financial situation. That's another reason you shouldn't blindly copy an AI-generated portfolio. Your financial plan should be built around you, not a generic prompt. AI doesn't know your life. Think about this. You ask AI, "Should I invest $20,000 in stocks?" How can it possibly know the full answer without knowing your situation? Do you have an emergency fund? Do you have high-interest debt? Do you need the money next year? Are you investing for retirement? Are you saving for a house? How stable is your income? How much risk can you tolerate? What happens if the investment falls 30%? Those questions matter. A technically attractive investment could still be completely inappropriate for your situation. That's why personal finance is personal. There isn't one perfect investment for everyone. The smart way to use AI. So let's create a simple framework. I call it ask, check, think, decide. Ask, use AI to learn, research, summarize, compare, generate questions, understand terminology, check, verify important information. If AI gives you a number, check where it came from. If it discusses a company's financial performance, look at the company's actual filings and official disclosures. Don't assume something is true simply because AI said it. Ask yourself, does this investment make sense for me? What are the risks? What could go wrong? Am I being emotional? Am I chasing something because everyone else is talking about it? Decide. Only after you've done the work, make the decision. And remember, you don't have to invest. Sometimes the smartest decision is waiting until you understand something better. AI versus simple long-term investing. Here's something that might surprise you. You don't need an advanced AI system to build wealth. In fact, one of the biggest mistakes investors make is assuming investing has to be complicated. It doesn't. For many long-term investors, the fundamentals remain remarkably simple. Spend less than you earn, build an emergency fund, manage high-interest debt, invest consistently, diversify appropriately, keep costs in mind, avoid emotional decisions, stay invested according to your plan, give your money time. AI doesn't replace these principles. If anything, AI should help you understand them better, not distract you from them, because there's a danger in having too much information. You can analyze 1,000 stocks and still make a terrible decision. Sometimes, the problem isn't a lack of information, it's a lack of discipline. The future of AI and investing. Now, imagine what investing could look like 5 or 10 years from now. AI could become much better at analyzing financial information. Personalized financial education could become dramatically easier. Complex financial concepts could be explained instantly. Investors could have tools that monitor portfolios and identify potential risks. Research that once took hours could take seconds. That could be incredibly empowering, but it could also create new problems. More people may believe they can predict markets. More people may trade frequently. More people may chase AI-generated opportunities. And when millions of people have access to powerful tools, the competition doesn't disappear. The market doesn't become predictable. Everyone simply gets better tools. So don't make the mistake of thinking, AI is powerful, therefore, I can't lose. The opposite can happen. Powerful tools can make mistakes more expensive. The biggest advantage you still have. Here's the good news. You don't need to beat AI. You don't need to predict the market better than everyone else. You don't need to find the next 100x stock. Your biggest advantage can simply be discipline. You can avoid panic. You can avoid unnecessary speculation. You can think long-term. You can invest consistently. You can control your spending. You can keep learning. And you can refuse to make emotional decisions. Those things may sound boring, but boring can be incredibly powerful when it comes to money. Because wealth isn't necessarily built by making the most exciting decision. It's often built by making reasonable decisions and repeating them for a very long time. If you enjoyed this video, subscribe to Just Invest for more videos about investing, money, wealth, and financial freedom. I'm John, and remember, use AI to make better financial decisions, not to avoid making them. I'll see you in the next one.